Every single person that I met, including myself, starts with this is a scam and a Ponzi scheme, and then you discover that it's not. And that's the journey. And Bitcoin really does sit uniquely in its own place as, you know, digital hard sound money. Because everything is changing, people are outflowing into gold and Bitcoin. Because gold and Bitcoin, you know what it is, the rules don't change. But Bitcoin even has less things that change. Most people have IOU gold. There are way more claims on gold than there is gold.
Very excited you're here. You are a true OG, and I think one of the few people I'd say that can really explain Bitcoin eloquently. And I reached out to you after I listened to what I think is a legendary Bitcoin explanation during a discussion you had with Peter Schiff back in February, which, some people might know Peter Schiff. He's like a well-known gold bug, but he tweets about Bitcoin a lot, which is interesting, you know. And so today I was thinking it would be interesting for my audience and also your audience to kind of like dive deeper into Bitcoin as the paradigm shift that it is, and how it helps us like reshape value and money in the world, and kind of like go down the anti-Bitcoin arguments with you and see if we can unpack them and help people better understand Bitcoin.
Okay, let's do it. I do think with Peter Schiff, there's an element of, because I remember like back in, I think he was really early. Like, so I got in 2011. He was around in 2012. And there's an element of he committed to a decision early. And then he built this whole marketing strategy out of sticking to that decision. So I do think he actually knows the difference. I think there was an element of, as the Bitcoin community got bigger, he ended up in this really weird situation where he thought, rather than capitulating and joining the community, I'll do this anti-Bitcoin thing so I get all the marketing, and I'll just stick to my original investment thesis and business model. And he just never adjusted it and just ended up as the last man standing against Bitcoin, in somebody that gets all the reasons for Bitcoin, but pretends that Bitcoin doesn't solve them.
I might as well be, but that's an interesting shtick for 13 years, don't you think?
I mean, if you're an advisor, and he is in the wealth management business, you know, he gets his theses right. He bets against the Fed, but betting against the Fed costs you a lot of money. You end up in gold for many years. You end up in foreign stocks and foreign currencies. And then eventually you are right, which is he is right today. But then you get that one moment and you've missed everything that could have happened in between. And so many people are in that, and Bitcoin was the highest performing asset in history, and a lot of people listened to him and so didn't buy, and he must get a lot of hate from that, really.
I would agree. Yeah, it's an interesting figure in this space, to say the least. But I mean, when I hear him debate you, he does share his anti-Bitcoin arguments with quite some conviction, I'd say. And again, yeah, I think how your rebuttals against it were actually, I think, very clear and rational, just as I've experienced explaining Bitcoin, right? Like it just is a certain thing, and there are certain characteristics and also values that emanate from it just being the thing it is. And yeah, you can recognize them or not. I think it's more. That's why people, I think, also say that Bitcoin is an ego test to that degree, right? Like, are you able to, see this different truth and kind of compare it to what you think is the truth? And if you can, you can obviously have a benefit from the asymmetric opportunity that Bitcoin is, but it's not for everyone in that sense.
Yeah, and every single person that I met, including myself, starts with this is a scam and a Ponzi scheme, and then you discover that it's not, and that's the journey.
All right, perfect. Yeah, let's just dive into the first argument or the topic that you talked about. So my idea here is that I have the anti-Bitcoin argument. I have your rebuttal from the discussion. I also link to the discussion in the description so people can check it out for themselves. And then I'll have a question for you to kind of unpack that further. So the first anti-Bitcoin argument is Bitcoin isn't unique, as there are other cryptocurrencies that can also be self-custodied and transferred globally, often faster, cheaper, and more anonymously. And your rebuttal was, Bitcoin uniquely combines secure self-custody, global transferability, and a reliable fixed monetary policy protected by the largest decentralized proof-of-work computer network in the world. No other cryptocurrency replicates these combined strengths. So my question for you is, what specifically makes Bitcoin's fixed supply and the proof-of-work network uniquely resilient compared to other cryptocurrencies?
Well, we have this concept in Bitcoin in the early days. No one cared about us. Like, we were such a niche community. You know, we were a bunch of cypherpunks. We were trying to figure out how to do transactions outside the banking system. You know, before I got involved, the very, very early people, you know, had this immaculate conception, which is that Satoshi and the cypherpunk mailing list, some people got involved with it. You know, you had some early miners like Hal Finney and various other early Bitcoin community members. No one believed it would succeed. There were previous attempts. You know, they were trying to make it work, code it together. But there was only one person or a couple of people that were willing to mine. And so they started mining. And as the market continued, more and more people started mining. And then they transferred a few transactions. And then people started to decide, well, how do we create a market price for people that want to buy and sell? And so more and more people were mining, and it went on. People were doing it from their laptops. And then as the network got more popular, you know, it is built into the protocol that the more people that are mining, the more difficult it is to mine, which means you have to consume more electricity, which is why it's called proof of work, because you have to prove that you're doing the work. And the more people that are contributing to proving that they're doing the work, the more difficult it gets to, you know, receive a block. And so eventually so many people were doing it that people decided, well, why can't I compete with everyone else and create a graphics card? So they then started doing it with GPUs, which is, you know, for more intense gaming types of consoles. And then eventually it hit a stage where as the ecosystem grew, people started to speculate on the prices. People started to use it in the dark web. People started to use it for online gaming. And then people started slowly to recognize that they could, you know, own their own money, spend their own money, and the money supply doesn't change. And so over time, it went up in value, and it was very, very volatile. And so more and more exchanges were created. The ecosystem just grew and grew and grew very organically, until eventually it hit the stage where the price of Bitcoin was worth so much that, you know, a group of people in China said, let's plug some semiconductor chips from Taiwan and manufacture a special machine, an ASIC, and let's plug it into the cheapest form of electricity in China. And let's see if we can mine these things and outcompete all the GPUs. And then they decided, well, let's create an industry out of it. There are more people that want to mine as well. And so as the price went up organically, as we went through more halving events, more people started to mine. And we just bootstrapped through this immaculate conception where Satoshi, you know, I believe that Satoshi is no longer with us, so they can't move their coins. But it doesn't really matter anyway, because they never actually moved their coins, and it would only, you know, they mined all those coins. The work was done. It wasn't pre-mined. It wasn't, you know, done connected to a character. Satoshi, when some of the early developers were invited to speak at a CIA conference around Bitcoin, Satoshi decided to leave the project. You know, when Julian Assange decided the banks won't let me run WikiLeaks, decentralized media, can I use Bitcoin? And, you know, it just organically went through this thing. And in the end, nobody controlled it. There was no one dominant miner. There were mining pools that were set up, and it just went more and more decentralized. And so everybody that joined it didn't have an unfair advantage. Somebody may have been involved earlier, and kept it. Some were involved really early and sold it to somebody else. It was, I would say, Austrian economics on a blockchain, a pure free market that had an immaculate conception, fair launch. And ever since then, we've had probably at this stage 22 million attempts at creating any type of some competing proof of work, some other consensus models, and a million different iterations of cheaper, faster, better. And they all end up more centralized. They compromise something in order to achieve cheaper, faster, better. And none of them end up achieving the properties of Bitcoin, which is kind of like a network effect the size of the internet, and trying to get everybody to rebuild on top of a new internet when no one can create a better version and get the network effect that Bitcoin has now.
Yeah, I love that. It's actually 37 million crypto tokens are out there now. Like 1 million a month are getting added. I had a great video with Jesse Myers about this, where we unpacked why we think a crypto is dead. But yeah, I agree. I think what many people have forgotten is that, and I really like what you said. It was like a free market, right? It was just like, okay, there's this protocol on the internet, the protocol for money, computer protocol for money. These are the rules. You can adopt it, and then, as you said, once people understood, hey, this is interesting, they were actually putting real world assets, energy, time, money, machinery towards expending energy to create this digital, let's call it a token for now.
Yeah, and very importantly, there was no price for a long time. So people were doing it for the technology.
Yeah.
And then the price kind of was a function of a market wanting to figure out whether they could buy and sell.
Yeah, I agree. So do you think we should talk about Bitcoin as not even part of crypto? I don't know what you think when people conflate Bitcoin and crypto with each other, but I'd say they are totally different.
Yeah, I do think crypto has been a massive psyop for the industry. It's a free market, so anyone can create the thing, and I don't believe in, stopping anyone. But I think it's been such a distraction for the industry that everyone that I know that hangs around for the long time, they come into crypto, and hopefully they end up at Bitcoin, and most people do. But some people, they come in crypto, they're basically investing in these characters like a stock. And slowly but surely they find out why Bitcoin is different. And Bitcoin really does sit uniquely in its own place as, digital hard sound money. I do think that the analogy of digital gold is useful. And everything else is like more like a stock that depends upon the management of certain communities that have almost like a foundation or a company. Yep. And a bunch of pre-mined tokens that they're looking to monetize over time, and eventually have to sell those onto you if they create enough perception of value, and very, very few of them actually end up with anything like Bitcoin.
Mm-hmm.
There's a massive premium for it will never change in a significant way without hitting massive consensus on a network that has got significant adoption from competing players, whether it's nodes, whether it's miners, whether it's exchanges, whether it's users. They all have the way that it was designed is significant. And if you look at everything today, even the environment we're in today, people thought they understood the US government. The Trump administration comes in, it rages a tariff war. And now the rules of investing in the US government through treasuries and bonds completely changes. If you're investing in stocks, you're dealing with humans and boards and decisions and wrong decisions and changes. If you're in dealing in anything other than a commodity, you've got all these counterparty risks, human risks, things can change. And so people like gold right now, because everything is changing, they don't know whether the US empire is going to be there. They don't know what the value of the dollar is relative to other currencies. And because everything is changing, people are outflowing into gold and Bitcoin, because gold and Bitcoin, you know what it is, the rules don't change. But Bitcoin even has less things that change, because there is still the possibility. Like, there was an announcement recently that I think El Salvador said it's got $3 trillion of gold under its ground that it could try and extract. Mm-hmm. And so you always have these changes that can happen. And while it's not common in gold, which is why it's preserved its value, with Bitcoin, it never changes. Exactly. The rules are identical and enforced by the community on, backed up on nodes all around the world, and enforced by the largest distributed supercomputer in the world that is hosted in many different countries by anyone that wants to fire it up, with countries that hate each other and can never geopolitically, strategically align to take down the network. And it would cost them billions, if not trillions, to try and execute such an attack.
I talked about speculation. I also think, like if you invest in Tesla, you speculate on Elon waking up in the morning, right? Like if Elon doesn't wake up in the morning, guess what happens with the stock, right? I think that's also the counterparty risk that you mentioned. So the second argument is Bitcoin's value, anti-Bitcoin argument is Bitcoin's value is driven primarily by speculation. Bitcoin's current market price is mainly speculative, driven by ETFs, institutional investors, and leverage positions risking large liquidation events. And your rebuttal was, though speculation is present, Bitcoin's long-term value and adoption are anchored by committed holders who regularly accumulate Bitcoin regardless of price, providing stability during volatility. My question for you is, how do speculative activities like ETFs or the leverage positions impact Bitcoin's adoption as a reliable store of value? And maybe also, can you see some merit also in Peter's position? Maybe we can also mention that in like the other arguments that we come across.
Yeah, so I mean, it's a bit of a nuanced term because people have a different definition. So for me, I distinguish between a trader and investor. I think a trader is somebody that has a certain unit of account, i.e. dollars, and says, I would like to invest in this asset class short term because I believe that it's going to make me more dollars, and I could even short it or something. And so speculation is what drives markets. And speculations, even in the most liquid markets in the world, let's say US treasuries and bonds, there is a massive rampant amount of speculation that makes these markets. And then you have different types of products that are built around that in order to get exposure to them in different ways. But in the end, the fundamental value prevails. And so with a stock, you know that it has key person risk, it has counterparty risk, it is there to achieve a goal, it has quarterly reports. If those quarterly reports are better than expected, the value goes up. If it's worse than expected, the value goes down. People make fake news and they speculate and they try and do all sorts of stuff. Some people accumulate massive positions and they use the fact that they can gain access to leverage to short the stock, manipulate it. This happens in every single market. And Bitcoin is no different. In fact, because Bitcoin is so volatile, it's got a rampant community of speculators that are always either looking to make more dollars or make more Bitcoin. And so this is the market dynamics. But the real question is, of all the assets in the world, which one is the hardest to manipulate long term is the real question. And I'd argue to you, the one that has a fixed supply is probably long term the hardest to manipulate, provided that it has a sufficient amount of liquidity. And so with all the shit coins, because liquidity is so low, one person can come along and completely corner and manipulate the market. With Bitcoin, you have to be a serious player to be able to impact price. So you've eliminated all those that have access to low capital or pre-mines or various other things. In the stock market, you know that at any one time, there is an authorized share capital, and someone could increase the number of shares. They could do a rights issue. They could do a split. They could decide to do a share buyback. They could engage in so there's all these human things that can happen that make it more subject to having to have rules around it, like insider trading rules and Chinese rules, and having to disclose if you're going to be doing a public bid of the company, and you have all these different rules. With treasuries, you've got, kind of your understanding of the creditworthiness of the US government, but the Fed can make a decision. They can decide to change interest rates. The US government could increase the debt ceiling, and therefore there's more treasuries in the market. A bank could suddenly have a bunch of assets go into distress, have to sell those assets in distress. There could be a carry trade where Japan is trying to control their inflation. They increase rates, and suddenly that creates a speculative attack, and people have to liquidate from their hedge fund the assets that were purchasing all these different stocks. So all of these things exist, and they also exist in Bitcoin. And the same with gold. Gold is, because the asset is held by central banks. For decades, central banks have been planning what a change of empire looks like we're experiencing today. And so they can use futures markets to oppress prices, and then they can accumulate more and more gold based upon people getting bored and going into different asset classes. But eventually, as we are seeing today, the manipulation stops, and it returns to its fundamental value, which is that no countries are trusting each other, so they don't know what the next world reserve currency is, so they're going into gold right now. Now, with Bitcoin, I'd say that there is the least number of variables that can change, and it is the only asset in the world that I know of where you can guarantee a fixed supply. Even gold inflates at 2% per annum. And so therefore, we would be lying if we said you can't short-term manipulate that. And it always has happened. People chuck loads of money into Coinbase. People speculate whether it's selling, announce something on Telegram, and, all sorts of games are played in order to manipulate the price of Bitcoin. But fundamentally, if you look at a chart of Bitcoin, if you zoom out and say it has been alive for 16 years, and in those 16 years, put it on a logarithmic chart, and you just see that it's not manipulated, long term. And I believe that it is harder to long term manipulate Bitcoin, adjusted for liquidity, than any other asset class in the world. And as the liquidity increases, it becomes even harder and harder and harder. And every 4 years in Bitcoin, you get new levels of market capitalization, new levels of liquidity, new use cases, and more people that say, well, I would come here because this market cap is worth about 10 million, highly speculative. Then there was the people that would come in because it's worth $1 billion market cap. Then you get the people that will come in because it's $1 trillion market cap. And then you get the people that won't come in until it's worth 10 trillion. And then eventually maybe a central bank says, we got $100 trillion market cap asset here with vast liquidity. At that point, we'll come in. And so I would argue, yes, there's manipulation. You can't change that. It is a free market. But it's probably the hardest. And as liquidity goes up, even harder. And that has just been the trend. And I don't see why that trend would stop.
I agree. It takes some time, but maybe another question. What is then speculation actually? Why are anti-Bitcoin people using speculation? I mean, when I think about that, it's speculating on the fact that Bitcoin remains the same, right? That it fulfills its promises. That's what I'm speculating on. Or the dollar falling, right? Are critics using it in the wrong way? Is it just like a simple word to use in an anti-Bitcoin argument?
Yeah, it's not unique to Bitcoin. That's the whole point here. There's nothing different in that argument that you could apply to any other asset class. But what I would argue as well, I guess what the argument is it 100% speculation? And so to me, there are many people like me, and I would argue that when an asset class cannot change, in terms of its fundamentals, of course, it can change in price and demand and all sorts of stuff. But in terms of the fundamentals of it, when you have reliability, I would argue that more people can make longer term financial decisions around reliability than you can around something that would change. And so, because of that unique property, I found that once people get Bitcoin, they do all sorts of crazy stuff. They go around the distractions and crypto and all that stuff. But most people end up realizing Bitcoin is where the value is. And my job is not to do things with Bitcoin. My job is to actually, I earn my fiat currency and I save it in Bitcoin after I've covered all my expenses with my fiat currency. And there are many, many people just like me that will do that. And I will buy the Bitcoin every single month, not because I need more Bitcoin. You know, I've been involved since $3. But I'm asking myself the question, what am I going to save in? And when I answer that question, the only question I have, because I know I've got a more than 4-year time frame, I'm not trying to, sell it, save it, and then sell it to pay my rent next month. I'm going to answer that question. The best place for me to park my funds, if I've got a more than 4-year time frame, is Bitcoin. And because throughout the whole history, I can't tell you it will happen in the future. I believe it will, but it has outperformed every hedge fund manager, every asset class, everyone there. So I would argue that this type of predictability and reliability has only grown the number of people that dollar cost average buy at whatever price it is that month, and actually become long-term investors, and they can do it in self-custody. So the ability to actually have full financial autonomy, and be able to own your own money and know that if my country gets authoritarianism or I don't like where it's going, I can transport my value wherever I want in the world. Obviously, I have to adhere to the rules, but that value can come with me, and there is no border around the constraints of trying to ship vast amounts of gold that can lead to confiscation, taxation, all sorts of questions that even if all sorts of problems. Mm-hmm. And we're experiencing that right now, where there's repatriation of gold, and they're trying to get it insured. They don't have the gold. They're trying to accumulate the gold. They're trying to put it in ships and airplanes and all sorts of stuff. Argentina just sent all of its gold to London. And London has a history, like with Venezuela, of just taking the gold if they don't like the current leadership of the government. And so because you have that self-custody, you have that reliability, you have that predictability in monetary policy, and you can take that value anywhere in the world, I'd argue that there are way more people that will become investors and less people that will speculate over time. And the speculators, what are they? They're people that are trying to get fancy and trying to use leverage in order to end up with more dollar value. And those people haven't quite understood that it's when you value your wealth in Bitcoin that you actually end up preventing all those mistakes and speculation. And we've got a community of people that try to impart these experience and lessons upon other new people to it more than anywhere else, because the end rule is just buy it every month, hold it for the long term, and
chill
and stop all the speculation.
Yeah, chill. I'd say it's. I talk about this a lot. It sounds too good to be true, right? Because many people feel that they should play this investment game and be on top of it in the news and Powell and whatever. Whereas, well, of course, the Bitcoin study is hard, but once you get it, that's already the reward, right? Because then you can chill. Like you don't have to play these games. And what you were talking about.
But that's a much bigger market as well. The market of people that don't want to know what the Fed's doing, don't want to analyze stocks, don't want to figure out any of this stuff. They just need an easy where they can get on with their life and they can have an asset that has historically beaten every other asset. I can't say it will happen again, but I believe it will. And there is a lot more people that want to have a life, but want the finances beating the Federal Reserve and the shenanigans of inflation.
Well, I think that again is a good bridge to the next one, because I'd say that is actually the use case, right? That's the value that people are looking for eventually. that's the problem or the need that they have. And the third argument I wanted to talk about is anti-Bitcoin argument is Bitcoin lacks intrinsic value. So Peter Schiff said something like Bitcoin has no intrinsic backing like gold. It relies solely on collective belief or adoption. And your rebuttal was Bitcoin's intrinsic value derives from its secure, decentralized proof of work network, immutability of its ledger, instant auditability, and digital scarcity, making it verifiable and trust minimized compared to physical assets requiring third-party validation. And my question to Goldbox is always, well, if I buy a gold coin in your little store, how do I know it's real? And then they're going to be like, yeah, there are very easy ways. I just need 4 machines and some, some chemicals, and then I can show you, that it's real. So my question for you is, what would you consider an actual credible threat to any of these elements that give Bitcoin its value?
Well, I would say to me, the true value is self-custody. So the ability to own your own and have full financial autonomy. Not everyone will do that. The ability to transport value anywhere in the world without all the limitations of physicality, auditability, any of that stuff, and middle people to verify. And then finally, the reliability of the monetary policy, knowing that there is no central banker that can change that. And so once you understand all those rules, that you can transport it and move it and send it whenever you want, what the supply is and the economics of it, then the real utility for me comes self-sovereignty and the ability to have full financial autonomy and own your own assets in a very, very scalable way. Some people will choose to outsource that. And so some people will make a bad decision, like putting it on an exchange. And then historically, exchanges create, fractional reserve Bitcoin. Because when everyone tries to get their Bitcoin, like an exchange like FTX, it turned out that they didn't have that Bitcoin because they were speculating with it. And so we have about a couple of million Bitcoins on exchanges. Those aren't Bitcoins. Those are IOU Bitcoins. And the funny thing is most people in gold have IOU gold. Mm-hmm. And we know for a fact, like, I don't think this is even indisputable, that there are way more claims on gold than there is gold. It's only in times like COVID when they get tested. And suddenly you can't get your gold. You're trying to get it from Singapore and you can't get it. And you might be the bag holder, the last man standing. And even then, the government could just go to the custodian, as they did in 1933, and say, hand in your gold. We'll take it. Now, you having it in self-custody is just removing many, many of these problems by you having full financial autonomy. Now, there is a downside to that actually it is an unnatural process that requires you learning how to set up a device where you can't rely on anybody and there is no insurance. And for some people, that's petrifying. And so they end up buying a Bitcoin ETF because, there may be tax incentives, or they may have their money in their retirement fund. And so they end up in a honeypot where BlackRock controls your Bitcoin for you. And sometimes you need to be there. Then you plan things like inheritance, and you want to learn when you can own your own money. There's like, how do you pass it on? Who do you trust it with? These questions as you grow your wealth become fairly tricky questions. And we have answers to all of them, but they're not as simple as just hold it at a bank and hope that the government will bail it out, and then understand that they're privatizing the profits, socializing the losses, and that's the reason why you got less money at the end of the year, because of the way the fiat system works. Yeah. So that whole trade-off. But I think if too many people end up with the easy option, and then they start storing it at banks, and then banks can do fractional reserve and all that type of stuff, it does not systemically change Bitcoin, because a Bitcoin and a Bitcoin IOU is not the same thing. But it does change the dynamics, and some people will get stung by that. And some people that self-custody, tragically, sadly, will not take the correct security measures, and they may end up losing their Bitcoin. And throughout history, that is a brutal, ruthless reality that you have the responsibility, and the solutions for it are there. But that is a trade-off, and some people are uncomfortable with that. And but that is the utility of it. And if we ended up just all giving it to banks, then we'd recreate the system. So there needs to be, at the moment, there's a very healthy ratio of people that choose full financial autonomy and self-custody. But I think our job as the Bitcoin community is to ensure that people understand those features, utilize that utility, because that is what makes Bitcoin so useful, and it also protects you.
I don't know if you saw, there was like a press conference of the Bank of England where they explained why they were so slow giving out the gold. I don't know if you saw that, but they had like a presser, and they said like, well, yeah, we have a certain system and they're numbered in a certain way, and sometimes we move them there and then we move them there, and yeah, we had a little snafu in the Excel sheet or whatever. It's them talking. That's their way of verifying the trust me bro type attitude, right? Like, I'm the Bank of England and I have a press conference and now I'm telling you, how it works. Whereas, with Bitcoin, you can just say like, do you have it or not? Like it just takes away all that nonsense.
Yeah, no, I mean, to be able to just say to somebody, I'm good for 100 million. Here's my address, and I can send a message. That is a use case. At the moment, for example, I was looking at some houses, and when you're in the high value house market, people don't want to waste time with people just looking at houses. So you have to verify your net worth. Normally you go to an accountant, and an accountant writes a letter, and then they don't actually know whether you've got a paper contract against that or something, So the ability to just actually prove that, yeah, you're good for the money. This is my wallet address. It is something you can technically do. And as more people integrate these technical processes, as it becomes a backbone of a financial system, you're able to programmatically and prove these things in a trustless network. And that's the whole point. Trustlessness is the key. I'd say that's probably the key utility of Bitcoin isn't it? Where else is there an environment where you don't need to trust? And that is Bitcoin. I don't know anywhere else where there's an environment where you don't have to trust.
And so the Bitcoin network is secured, obviously, by computing power, right? The biggest computer network in the world. And the next argument I wanted to talk about that Schiff used is Bitcoin's network security is vulnerable to price drops. So he says a significant Bitcoin price drop, like 90%. We can even debate if that's going to happen anymore, but that could severely decrease mining activity, undermining network security and the reliability, and thus, the future promise of Bitcoin of staying the same, being resilient against attacks. And so your rebuttal was Bitcoin's built-in difficulty adjustment automatically recalibrates mining profitability, allowing network security to rapidly stabilize even after significant price corrections. And so my question is, I think this answer could also be very short, but do you think any prolonged low Bitcoin prices could actually damage network security or the decentralization? And maybe tie in what we talked about in the beginning, where, depending on the attractiveness of being a Bitcoin miner, there's actually a real world market that adapts to, let's call it that business opportunity.
Yeah, I mean, people from the beginning, they've always created these theoretical concepts, and these theoretical concepts were debated before Bitcoin was actually launched, or and so the design of Bitcoin was to factor in these types of events, and I've been through them all. So I went from a $30 Bitcoin that crashed to $3 in a couple of days. That was a 90% correction. I've been through, a $20,000 Bitcoin that crashed to $3,000. I've been to a $69,000 Bitcoin that crashed to $17,000 over time. And so the way that Bitcoin works is it's secured by miners. And, when you're mining, basically all it does is it means that a Bitcoin is verified every 10 minutes. If you could end up in a scenario where for 2 weeks, there's a big queue to get in a block. and then those transactions take longer to be confirmed. It doesn't mean you can still send it instantly, but to get a miner to confirm your transaction, it could take longer than 10 minutes. And when that happens, the difficulty rate adjusts. And you don't need to know any of this stuff, but it's useful if you're interested in understanding it. And what that means that as the time to confirm a block extends, it means that we need to adjust the difficulty rate. And so therefore it either gets easier to mine or harder to mine. And as it gets harder to mine, those that are less profitable miners may need to switch off their equipment, de-shelf if they're completely out of business. And only those that are more efficient are able to mine. But in an environment where the price radically corrects, if a business has managed, a mining business has managed their expenses, they can ride through it. Another business will go bust because they didn't have enough cash flow to sustain the lower prices, because a lot of their costs of electricity are in dollars and they've got to sell some Bitcoin to pay for it. And you just get a recollaboration of some businesses that go bust, others that are efficient. And as less and less people mine, it becomes easier and easier to mine a Bitcoin, which creates a new profit opportunity for another new miner to come along and set up a business. Yeah. Or that business that switched off his miners and de-shelved can then switch them back on. And you just get a recollaboration. So there's a corrective mechanism designed for that. And every time people have talked about this death spiral thing. And I've been through all the crashes, and it never happens. It's an ultra efficient market that we call anti-fragile, where every time there is a disaster, the market just adjusts to that new reality, and Bitcoin just carries on. And everyone else panics, and some people sell, other people buy, but the network just continues because it's already factored in these different mechanisms.
I think this ties into what we talked about before. There are so many, say, market and psychological elements that work together that create certain incentives. Before you adopt Bitcoin, when you adopt Bitcoin, even when you're mining Bitcoin, right? That all play into your contribution to Bitcoin in that sense, right? Like, even if we would drop to a level where you can mine with a GPU again, maybe even in a day, 100,000 miners would come online, right? Because there are that many people that then see an economic opportunity to then start mining, which then increases the difficulty adjustment, which then eventually makes mining with GPUs obsolete again, right? And then so it's just that cycle. I think, I don't know. Like I think this is a great answer. I don't think there's anything else to say to that, right? Like, it's just economic incentives that align or that adjust based on in this context how easy it is to mine Bitcoin. Yeah, I don't know what else to add to that. All right. The next one is Bitcoin wealth is concentrated. So the argument is Bitcoin ownership and wealth are highly concentrated among a small number of early investors, exchanges, and large institutions, raising concerns about manipulation. Your rebuttal was significant Bitcoin holdings among large entities often represent millions of users, like on exchanges, and are transparently auditable. The distribution becomes more decentralized over time as adoption grows. And yeah, I think this is a really good question to tackle, because people conflate the decentralization of the proof of work network, the security of Bitcoin, with the ownership. And so, yeah, do you think Bitcoin wealth concentration poses any meaningful risk to decentralization or governance? Maybe I already answered this question, but yeah.
Yeah, I mean, so to me, ideologically, I would like Bitcoin to be in the hands of as many people as possible. But the reality is you're dealing with human psychology. And so there's nothing fundamentally different about Bitcoin than any other asset class. In fact, there's less things. When you create a new company, you create some private equity, you end up with 100% of that company. And over time, you give little chunks of it to investors and employees and share schemes and various other things. But most companies have a massive concentration of wealth, and eventually it goes public. And when it goes public, it distributes to more people. But, even gold, gold is hugely concentrated in the hands of central banks. because they are the natural accumulators of the vast amounts of gold. The interesting thing about Bitcoin is the fact that you even know how to ask that question, because you can go on the website and you can pull all the data which is backed up on tens of thousands of nodes all around the world. Mm-hmm. And you can see the exact concentration of wealth and how much Bitcoin is in every single wallet without necessarily knowing who it is. But the larger wallets, we tend to know who they are because people have reverse engineered it over time. Like we know that Satoshi and those wallets have about 1 million Bitcoin. I personally believe that Satoshi is no longer with us, so it won't move. But we know that, and that's factored into the equation. We know that the Chinese government confiscated, a bunch of Bitcoin. We know the US government confiscated a bunch of Bitcoin, and certain players decide to disclose their wallet address for verifying reasons, like exchanges. So, Binance or Bitfinex or Bitstamp or Coinbase, they reveal the wallet addresses because they want to do proof of reserves. And so you can see this is a Coinbase wallet. And a Coinbase wallet probably represent, a Binance wallet, there's like 260 million users on Binance. How many of those make up, that wallet? Who knows? But there's a lot of people. And so the point is that, concentration of wealth is something that I would love for Bitcoin to be more distributed, but we're not changing human psychology here. There are people that will accumulate Bitcoin as a free market. There are people that will get it earlier. There are people that will join later. And every single asset in the world always has a concentration of wealth of certain people that were a part of the game, created the game, or whatever it is. But with Bitcoin, it's completely different to all of the other cryptos where they pre-mine the coins, and there was massive concentration through an unfair mechanism. Bitcoin launched fairly, and that ended up concentrating wealth in those that believed in it, were around it. And many of them, though, have sold them. I know people. I spoke at the first Bitcoin conference in Prague, 2011, and I know a person there that was around, had a lot of Bitcoin, and doesn't have a lot of Bitcoin today. Like, there's people that have sold it, traded it, done stuff with it, lost it, various other things. So the reality is I'd love it to be more. I'd love more and more people to do it, and that's why we do these podcasts, because we want more and more people in, more and more people to get in and distribute that wealth. I make a point of distributing some of my Bitcoin in areas through charity work or whatever it can be, and various other things over time. But the point is it's not unique to Bitcoin. It's not systemically risky. And the fact is, it's probably the only asset class where it was launched fairly, and you can verify without revealing people's identity the exact concentration. And they tend to focus on the large wallets, and those large wallets tend to be services that are pooling Bitcoin for lots and lots of people. So it's pretty concentrated. I would love it to be more distributed, but human psychology doesn't change. Many people know how to accumulate wealth, and some people don't.
Well, Bitcoin is for anyone, but not everyone will get it, right? Like that's the point. And I agree with you. Like I also hope, and I mean, this is why we're talking, right? To just reach more and more people. And I agree. I think Bitcoin is, especially now compared to when I got in 2013, I got in. By the way, I also bought at between 100 and 300, sold it all at 4,000. I didn't get it then. But now I'd say, this is kind of my thing now, but I'm saying like Bitcoin is an asymmetric opportunity based on publicly available information. Like anyone can study this. Like it's all out there. There are no secrets to learning about Bitcoin. And even when you start using the tech, you can verify everything for yourself. You can verify the rules of the money protocol for yourself. Like there is you do not have to trust anyone else. That's a trustlessness that you mentioned, right? And so there isn't anything else that you can actually do that with. So the opportunity is there, but you just have to do the work.
I'd also argue from direct experience, having been here since $3 and met, worked with hundreds of thousands of people, that have got into Bitcoin. I'd argue that I think it's easier to risk adjusted hold Bitcoin at $90,000 with the current understanding of where Bitcoin is going,
yes,
than holding Bitcoin at $3 and holding on to that all the way to today. Very few people, like the level of certainty that exists today, which is why it's lower returns, relative to the level of uncertainty back then. We were, a bunch of crazies that, just had zero chances of success. Bitcoin is a miracle, quite frankly. Like, it should not have succeeded. It really shouldn't, because it's just such a wacky concept. It's actually remarkable that it's got this here, but the level of
signal by itself
you have today relative to risk adjusted back then, you are way more likely to sell your Bitcoin than you would be today.
Yeah, I'd say that's the signal by itself, right? The fact that it still exists after 16 years, All right. Argument number 6, the not the last one. I have 7. Bitcoin is not effective for privacy. So the argument Schiff used is Bitcoin leaves an extensive digital trail, undermining privacy, making it unsuitable for users needing protection from oppressive regimes. Your rebuttal was Bitcoin prioritizes censorship resistance and secure self-custody, not complete anonymity. Privacy can be enhanced through supplementary methods, but Bitcoin's primary strength remains secure global transferability. And my question for you is, do you think enhancing Bitcoin's privacy features would fundamentally improve its utility, or would it induce new risks? And maybe to add to that, if you download the white paper, you search for privacy, Satoshi talks about not exposing your public key. So if we're really honest, there's not that much about privacy in the white paper. But my personal idea is that, we can build many technologies on top of Bitcoin as a base layer that eventually helps people. But what are your thoughts on this?
Yeah, so my thoughts on this is that Bitcoin's not private, it's pseudonymous. And everyone should know that. You can have as many wallets as you want. You can engage in types of mixing activities if you're a bit more sophisticated. You can get wallets that will do lots of things to try and obfuscate transactions. But it's not perfect, because every transaction is on a public blockchain, and services will get ever more sophisticated to try and reverse engineer those. And when you buy it at an exchange, you have to KYC, so then you have to reveal identity to that exchange. And then if that exchange gets subpoenaed, then they may be able to attach your wallet address to that identity. These are all things that are known and are understood. And so for me, the important part is that is the rules. And so if you want complete privacy, then this isn't the solution for you, because you've got all of those flaws. You can try and work on those flaws, but this is the rules of Bitcoin. And I would argue that changing that at layer 1 might introduce uncertainty that ruins the fundamental principle of what Bitcoin is. And that's not a risk, because it would only have the ability to fundamentally change Bitcoin is incredibly hard. So you have to get massive consensus amongst miners, node operators, the community. You have to propose Bitcoin improvement protocols. It has to go through a process, a code testing, and all this stuff. And that is why Bitcoin is very, very hard to get these changes. And privacy was always something we've been debating the whole way through. Some people really think it's important, other people don't. But the rules are the rules today. And what the community reached consensus on after a massive, massive public debate, where there was a public war. And this is why I love Bitcoin, because you're not going to get a major change without a massive public war that involves all people that want to be involved in that, which was the block war, block size debate. the consensus that we ended up upon, and there was a massive battle to achieve it, is that some changes were made where you can have a layer 2 network. And a layer 2 network meant that you can lock up Bitcoin, and companies can do it. And then you can create what's called a lightning network. And within that lightning network, it's not the same as Bitcoin, but you can transact instantly and privately between something called channels. Now, that technology exists, and that's factored into where we are right now. So if you do want private Bitcoin, then you have to either wait for companies to make solutions around Lightning Network channels. It does exist today, but it may not exist in the form that you want. Or you need to invest in businesses or create businesses that creates the solution that you want. So Bitcoin layer 1, I would say, is a finished product without, with tweaks to enhance layer 2. And then layer 2 is a technology play where we can make Bitcoin way, way, way more useful, but we don't fundamentally change the principles by which people said, I'm committing my savings to this commodity, knowing the rules that exist today. So I think anything that fundamentally changes layer 1, where the rules change, because if you think about it, if you made it all private now, an exchange might say, or an ETF might say, yeah, we can't work with that. And so you might get lots and lots of exchanges saying, as a regulated company, we are unable to work with a private coin. And so therefore you fundamentally change why people are saving in Bitcoin. And I think avoiding that, I think we're there now. The privacy solutions exist. The rules are understood in layer 1. And anything that fundamentally changes layer 1, firstly, it will probably not get through. And secondly, if it's a drastic change, then I think it would have a hit to people's faith that Bitcoin is a commodity that will never change.
Yeah. All right. The last argument that Schiff used was the uncertainty around Satoshi's roughly 1 million coins. You already mentioned it before, that represents persistent market risk, as selling them could severely affect Bitcoin's price and confidence. I think we also heard Jamie Dimon say, when Satoshi comes back, or he even said the wrong name. I think, he's going to sell all that stuff and then it's going to zero. Blah blah. You said if Satoshi's coins move, the market would quickly adapt. Bitcoin has historically recovered from large sell-offs due to its underlying fundamentals of decentralization, scarcity, and global adoption. And my question for you is, how significant is the risk of Satoshi's coins being sold, and how could the market realistically adapt? I think you mentioned you think Satoshi is no longer with us. I don't think so either. I wonder who you think it is, but is there really any risk here?
Yeah, and I think it's factored into the equation already. And so there are 1 million Bitcoin approximately that belong to that were mined through proof of work fairly by the group of people or people that identify as Satoshi, that nobody has been able to prove categorically who they are yet, that I have my own theory around who it is. And I personally believe that person is no longer with us, but the risk of those keys being found is a genuine risk that exists within the market. Now, what does that actually mean? How do you factor that risk into the equation? Well, the answer is Bitcoin's been through black swan events on multiple occasions. We at one stage, almost 60% of all the mining hash power was in China, and China implemented a Bitcoin mining ban. And that crashed the price significantly. And then it took probably 3 to 6 months. And then suddenly people started distributing those mining machines all around the world. An industry evolved in Texas in the US where they saw a massive opportunity in supporting Bitcoin mining because you could repurpose wasted electricity and you can make the mining grids more efficient. Others said this is an opportunity to transition to a very efficient, renewable form of energy where we think we can mine better in this region. And essentially, there is a black swan event there is a big correction in price. Those that don't want their Bitcoin anymore based upon that reality sell. A lot of people will sell. Other people come along and say, well, I'm in it for the long term, I'm going to buy. And I know that this isn't systemic because none of the rules of Bitcoin would change. It just means there's another million to hit, or Bitcoin to hit the market. So at the point, let's go to the extreme. Firstly, I don't think it will happen because the person that I believe can't move it. But let's say someone else found those private keys and was able to move it.
Or with
then
quantum,
they know, yeah. Then they know it would, or it was someone else that's got it. Then they would know there would be a big correction in the price as soon as they move. The market would see that instantly. That would crash the price. That would recollaborate a lot of, as we discussed, with miners. Some would suck that up. And, some may even do it as an OTC trade, whatever it is. But Satoshi would be known. There would be a whole bunch of FUD around who is that character. But already it is irrelevant. There's nothing Satoshi can do to change the rules. So it's a distributed supercomputer with open source code that is, that has a way of contributing and upgrading the code that has nothing to do with Satoshi. So Satoshi has no impact, could not do anything. The only thing Satoshi could do was move those coins and sell those coins, which to me just impacts price and doesn't change anything about the fundamentals of Bitcoin. So to me, people like me would be like, hey, this is a great opportunity to buy 10,000 more Bitcoin, and other people would see, I think, as an opportunity, saying Bitcoin doesn't change. But if we actually crash the price down to something radical like $1,000, there's so many people that hold the belief in what that is that they would see this as a once in a lifetime opportunity to end up with a bunch more Bitcoin. So it impacts price. It doesn't fundamentally change anything. It's factored into the equation right now. And I don't believe it will happen, but it could.
Fully agree. I think this is also kind of like a flawed anti-Bitcoin argument because it's, I think it's very fiat thinking, actually, right? Like, because what you're saying, it's just a huge supply coming online. But that's basically it, right? So if you don't fully understand what Bitcoin is, you might be distracted by this, and then the price goes down and you'll give it up. Even if, that's why I mentioned quantum, right? Because people are talking about like, okay, should we let all these old addresses be hacked and actually have this supply coming onto the market? I tend to lean towards just that, because that would be the most organic way to get any stuck Bitcoin, let's call them stuck Bitcoin, back into circulation. And that would be the free market that I think we champion here, right? So that would just align. And I think the price crash, I think it would actually be a very interesting event. If that would be an anticipated event, I think that would be fairly entertaining actually to watch.
Yeah, let's get it over with. Let's get it done.
Right? Yeah, I agree. All right. If you have like 10 more minutes, I have a few more FUD questions that I think you would be perfect to answer. And I think the main one is, we talked about the security and the decentralization, right? I think in the past there were lots of discussions around 51% attack. You mentioned, how much it cost for 10 minutes of control of the network. I think estimates are around 10 billion plus, where I think actually the conversation is interesting because you could talk about, okay, do I want to spend 10 billion to mess with the network for 10 minutes and then become irrelevant, or should I just buy 10 billion in Bitcoin? I think that trade-off risk reward question already exists for any actor that would want to jeopardize the integrity of the network for only 10 minutes, right? But yeah, do you think there could be some sort of simultaneous ban or regulation or attack on Bitcoin by, let's say, state actors or even a commercial actor like, I don't know, Google or something? Like, is there a relevant scenario that goes through your mind there?
Yeah, so the fact that we're even having this conversation shows the extreme level of circumstances that people that have to factor into the equation of why Bitcoin might fundamentally change. So let's go through one of those extreme circumstances. A known attack vector called a 51% attack, which means it's more like a 75% attack to do it in practicality. But what it means is that if you can accumulate 50% or more of the hash power, then you can play a game where you could end up stealing some Bitcoin, writing a version of the chain, verifying it yourself. It's a theoretical attack. It has actually happened on all other chains. It's never happened on Bitcoin. So everything that tried to fork off from Bitcoin ended up being 51% attack. It's proven that to be a very effective attack, as showing the difference between Bitcoin and the forks. Mm-hmm. People that try and a fork is when you create a copy of Bitcoin, like Bitcoin Cash, Bitcoin SV are the famous examples. They try and take the community with them. They try and take all the miners with them. And then you end up creating a centralized mess that's 51% attacked, which is what's happened every time. But it never happens with Bitcoin. The reason it doesn't actually happen is because there is no rational scenario by which you would attack the network to try and create some fake Bitcoin to scam an exchange and then get that money off the exchange and then end up with more money than the loss of value of trying to perform such an attack.
Exactly. Yeah.
That would cost billions of dollars, and you would have to actually build the infrastructure or control the infrastructure of over more than 50% of the miners, which at this stage, just so you know, we're at about 1,000 exahashes per second. We are solving 1,000 quadrillion maths problems every second to secure this network. There has never been anything like it. It is incomparable to the largest supercomputer in the world, which it doesn't quite compare to, is 1,000 times less powerful. And then any other proof of work network is like a small, insignificant amount relative to the amount that is secure in Bitcoin. So that makes it harder and harder and harder and more expensive to perform such an attack. So then you have to look at the scenarios of, well, what if somebody was doing it out of just trying to attack the network? So what type of scenarios could you imagine? Let's say the United States government has already released an executive order by Trump to build a Bitcoin strategic reserve. So let's say America builds a Bitcoin strategic reserve and it decides that it wants to own like over 1 million Bitcoin or 2 million Bitcoin to prop up its do a monetary reform and transition to hard money. It would have to probably nationalize a company like Strategy. It would have to do an executive order in order to confiscate all the Bitcoin backing the Bitcoin ETFs. Then America could accumulate a couple of million Bitcoin and control about 4%, own about 4%. And that's an important word. In Bitcoin, it's not proof of stake, which it's proof of work. It means owning it doesn't mean control it. Owning it means you can do stuff with it. You can try and manipulate price. You can try and borrow against it and create derivatives or whatever you want. But you can't control it. With proof of stake, which was a competing model, ownership equals a governance vote in the network. And so if somebody accumulates a massive position, they have all the governance in that network. Bitcoin wasn't designed that way. It was designed to not let this happen.
Which is fiat, basically, right? That's fiat, basically. And maybe to add, in Bitcoin, if you decide to acquire Bitcoin as a nation or even as a company, I think as a nation even more, you're also incentivized to start mining to actually control a portion of the network work that you can use to do your own transactions. That exactly. China, for example, doesn't have to approve for the US.
Yeah, and if you look around the world, like it's estimates, you can't get exact, but about 40% of the hash power is in America, distributed amongst 20 public companies, private miners, and various other things. About 21% is in China. You don't know who these miners are. About 11% is done in Russia. There's about 6% in Iran. And so these are all countries that geopolitically and strategically are on the other lines. You've got Europe, you've got South America. So it's distributed where it's impossible to coordinate. Then you have mining pools on top of that, which is another distribution. You know, we're always working on trying to be better and more decentralized, but still it's impossible to do a 51% attack unless you wanted to take down the network. So then you would have to be, in this scenario, Russia or someone that wants to strategically take down the Bitcoin network in order to crash the dollar because they've got 2 million Bitcoin and America's transition to a hard money standard, and they want to crash the dollar by wiping out Bitcoin. In this set of scenarios, they would have to print their currency to accumulate such an amount of power to perform such a 51% attack. And it would be more like a 70% attack to get there and go unnoticed, which is impossible because there's always adjustments to, like, you know, there was one example, a mining pool called ghash.io. They started to approach about 40% of hash power at one time, way back in the day. I can't remember when it was, maybe 14 or something. And immediately, as soon as it approached it, everyone just started reallocating their mining to a new pool. You know, it just adjusts. It adjusts to the reality. So if this were ever to happen, then in theory, Russia could crash its own currency to try and crash the Americans' Bitcoin strategic reserve, when probably it would have been just much, much better to actually start mining and reallocating its energy to mining Bitcoin, build its own position, and compete. But that's the type of scenario that would need to happen in order to theoretically perform this 51% attack. And if you're not buying Bitcoin because that might happen, then you just need to understand risk reward. Because, you know, if you think that's a reason not to own Bitcoin, then you'll be the last person in the world, like Peter Schiff, buying Bitcoin when you realize every single problem in the world has done. And by the way, there is never any asset class in the world where every problem and every black swan event and everything could disappear. But the level of extremity that's required in order to allow for that scenario to happen, I mean, I couldn't even put a probability on it.
Yeah. I think this is a whole different podcast, but that goes towards, you know, the whole software theory of Jason Lowry, you know, the whole power projection trade-off in this example that you are giving, right? Yeah, should I print my own currency, buy hardware to eventually perform this this attack, or should I just buy it, conform to the rules of the Bitcoin network, and then you know, gain value from that eventually? I think that's very interesting, just that theory by itself. All right. I think we went through a lot of things, and I want to thank you for your time. I think it's really, really interesting to kind of go through these arguments that we hear a lot, and hopefully we unpack them a bit more with more rebuttals so people can understand.
Can I give the final one? Can I get a bonus one?
Of course.
Did the CIA create it? Well, the CIA did create some of the cryptography technology that exists behind Bitcoin, but these are open source libraries that the Federal Reserve, the whole world relies upon. If you can crack these cryptographies, then, you know, there is no backdoor because it's a distributed supercomputer. It doesn't matter who wrote the code. It's got every type of developer that's been through all of these audits. You know, this is the entire internet, the entire foundation of intelligence agencies that don't want to leak information to each other, i.e. the KGB and the CIA are using the same types of technologies. And so if this is an issue for Bitcoin, it's also an issue for the KGB. It's also an issue for Mossad. It's also an issue for the CIA. It's also an issue for the Five Eyes. And trust me, they don't want each other knowing each other's information. And so even if it was, we could change the version of the cryptography, which brings me to my final one. What about quantum computing? Quantum computing is a known black swan event that will happen in the future. and it is a global problem for the entire world to fix. It's not unique to Bitcoin. But once the world has decided what quantum resistant cryptography looks like, and there are many people in the Bitcoin community working on this problem, it is, again, one of those black swan events that would create adjustments, because we'd have to upgrade from SHA-256, which is a version of cryptography that may not be quantum resistant in the future. Then you have to adjust it to quantum resistant cryptography, which is an area of computer science that everybody's working on, which is used, it's a problem for everything. You're talking about Armageddon, nuclear power plants, nuclear weapons, the Federal Reserve, intelligence agencies, the internet, Google, everything breaking systemically. That's when you want to own gold in that scenario. But even Bitcoin has a mechanism where we've already hard forked. We know what that looks like. It is a disruptive event. It involves a war, a civil war online. But you switch to quantum resistant cryptography. And then the miners would actually have to upgrade their equipment for that new cryptography. So it would be a disruptive event, but it would be a similar type of event where it doesn't break Bitcoin. It breaks the whole world. And then we would adjust as the whole world adjusts to quantum resistant cryptography. And it's a black swan event that changes the dynamics, and then Bitcoin moves on.
It would especially disrupt your banking infrastructure written in COBOL, a software language from the 1970s, right? So I think, when you think about that, I fully agree. Maybe, okay, I'll add one more. What about a global EMP attack and or meteor impact?
Yeah. Well, look, if the internet gets taken down, we've worked on satellites and various other infrastructure. But at that stage, there is a role for gold. And the role for gold is that if we move into the whole entire digital system blowing up, firstly, we're probably dead. We're probably beating each other up. And rather than using your gold to store your value, you're probably using it to get people out of your house and knocking them out because everyone's trying to steal your gold. So there is a level of, and there is a role of the physical world in case the whole digital infrastructure and the world as we know it today, and you just happen to survive that.
Yeah, I agree. I call these like the end of the road arguments. Whenever people say it to me, I say like, okay, if I answer this properly, will you get into Bitcoin, right? Because there is no other bigger anti-argument than the EMP or the comet impact. And yes, I do use, there are satellites in space that run Bitcoin. So even if we get down to 2 nodes that verify the truth ledger, the time chain here, after some time when, more and more people connect to this network again, it basically still survived, right? And I think that's a nice loop back to the beginning. You have to be able to conceptualize that and connect that, I think, also to the probability of the event to then make your decision, whether Bitcoin will survive something like that. So, thanks, man. Thanks so much for your insights here. I hope it's valuable for our audience watching. And man, it was great talking. So thanks again.
Awesome. I'd just say get off zero, man. The best way to learn this stuff is to do it. If you're on zero Bitcoin trying to have all of these problems solved, the best thing to do is say, what allocation am I comfortable with right now? Get off zero, learn what it's like to own your own money, spend your own money, and have a monetary policy you can rely upon. Play around with it, send it to your wife, send it to yourself, secure it for yourself. And even if all you did is say, I'm going to buy a little bit of that every month for the next 4 years, every single person in the world that has done that has outperformed every single asset class that has ever existed. And I think is irresponsible not to hedge for maybe Bitcoin may just succeed.
Couldn't agree more. That's a great ender. Thank you. I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, please like this video if you want to help shine a light on the message of Bitcoin, and subscribe to my channel to stay connected. I hope to see you for a next episode.